As of this exact moment, Opendoor Technologies Inc. is trading at 7.80 USD, showing a slight intraday gain of 0.020 points or roughly 0.26% in the green. If you are looking at the tape right now, you might see this flat movement and assume it is a quiet day, but do not let the low volatility in this specific session fool you. When you zoom out just a fraction on the charts, what you are actually witnessing is one of the most violent, high-velocity repricing events in the entire real estate sector for late 2025. We are sitting on a stock that has effectively refused to die, rallying from the depths of sub-$1 delisting fears earlier this year to stabilize near this $8 handle. The expectation from the street, and certainly from the headlines you see on CNBC or Bloomberg, is that this is a meme stock resurgence, a ghost rally driven by retail speculation and the lingering fumes of the 2021 tech bubble. They tell you this is just another speculative squeeze without substance. The reality, however, is far more complex and decidedly more interesting. What we are seeing is not just a squeeze, it is a fundamental capitulation by the market on the thesis that iBuying is dead. The market is beginning to price in a scenario where Opendoor is not just a survivor, but the last predator left in an ecosystem that killed off Zillow's ambitions and terrified Redfin. You are not looking at a real estate company today. You are looking at a derivatives trade on the velocity of money itself. When liquidity in the housing market was frozen by the Federal Reserve's tightening cycle, Opendoor was suffocating. Now that we've seen multiple rate cuts throughout 2024 and 2025, the oxygen is returning, and the price action at 7.80 USD reflects a market that is trying to calculate exactly how much leverage this company has to a recovering housing turnover rate. This disconnect between the public perception of a failed pandemic darling and the institutional reality of a monopoly in algorithmic home flipping is where the opportunity and the danger lie. Let's look at the immediate market dynamics driving this price today. The volume profile suggests a battleground. You have heavy turnover in the shares, which indicates that the weak hands, investors who bought in at the lows of 50 cents or $1, are cashing out, taking their massive percentage gains. Absorbing that supply are new entrants, likely a mix of momentum algorithms and risk-tolerant retail capital flowing through platforms like Robinhood stock trading apps and SoFi invest accounts. These buyers are betting on the breakout. They're looking at the chart and seeing a consolidation pattern that often precedes a move to double digits. It is fascinating to watch the order flow because it highlights the divide in the market. On one side, you have the conservative money, the types who stick to Schwab Intelligent Portfolios or Fidelity mutual funds who will not touch this stock because the balance sheet still looks terrifying to a traditional value investor. On the other side, you have the liquidity chasers, who realize that if the housing market thaws even 20%, Opendoor's revenue creates a leverage effect that could send the stock vertical. To understand why this price level of 7.80 USD is critical, you have to understand the structural shift in the housing market that is playing out right now, in November 2025. For the last 2 years, we talked about inventory lock-in. Homeowners were sitting on 3% mortgages and refusing to sell. That killed Opendoor. But time is the ultimate solvent. People have to move. Families grow, jobs change, and the lock-in effect is eroding. We are seeing early signs that inventory velocity is picking up, and unlike a traditional brokerage that makes a small fee on a transaction, Opendoor takes the entire principal risk. This is why the stock is so volatile compared to something stable like Apple stock or Microsoft stock. If Apple sells fewer iPhones, they make less money. If Opendoor fails to sell a house, they are stuck holding a depreciating asset with carrying costs that bleed cash every single day. The market is currently bidding the stock up because it believes the bleed is stopping and the flow is starting. Now let's talk about the competition, or rather, the lack thereof. This is the contrarian take that most bearish analysts miss. When Zillow exited iBuying years ago, the narrative was iBuying is a bad business. The reality might actually be iBuying is a winner-take-all business, and Opendoor won. By surviving the nuclear winter of interest rates, they now operate with virtually no direct institutional competition in the instant offer space. If you go to Interactive Brokers and look at the sector peers, you'll see traditional agencies and listing portals, but you won't see anyone else willing to put their balance sheet on the line to buy a house in 24 hours. This monopoly position gives them pricing power they didn't have 2 years ago. They can widen their spreads, the difference between what they pay a seller and what they sell the house for. Because for a seller who needs cash immediately, Opendoor is the only game in the town. This margin expansion is the hidden story behind the stock's recovery. However, we need to address the elephant in the room, the algorithm. The core of Opendoor's business is a pricing model that needs to be smarter than the market. In 2022 and 2023, that model failed. It overpaid for houses right before the market dropped. The bullish case for the stock at $7.80 assumes that their AI and machine learning models have been recalibrated for the new volatility regime. This is where the comparison to Nvidia stock becomes relevant, not because they are in the same sector, but because the valuation premium is being applied to the technology, not the hard assets. Investors are betting that Opendoor's data advantage, years of granular transaction data, has finally matured enough to predict local housing trends better than a human agent can. If they're right, Opendoor isn't a house flipper. It's a liquidity provider, similar to a market maker on the NYSE, and that commands a much higher multiple. I want you to pause for a second and think about your own financial setup. Most people reading this probably have a mix of assets, maybe some ETFs in a Fidelity brokerage account, some crypto on Robinhood, or a managed account with SoFi Robo-Advisor. Now ask yourself, do you own any real estate? If you do, you know how illiquid it is. It takes months to sell. Opendoor's promise is to turn that illiquid asset into cash in days. That utility has immense value, but the cost of providing that liquidity is massive capital intensity. This brings us to the balance sheet. Despite the optimistic stock price, the financials are still a high-wire act. They are sitting on a significant pile of cash, yes, but their debt load is the counterweight. They are leveraged. In a high-rate environment, that debt is expensive. Even with the Fed cutting rates recently, the cost of capital for a company like Opendoor is significantly higher than for a blue-chip tech firm. They have to turn over inventory fast enough to outrun the interest payments on the debt they used to buy the houses. It is a race against time every single quarter. This high-stakes nature attracts a very specific type of investor. You see a lot of activity in the options market for Open. Traders on Interactive Brokers trading platforms are selling volatility, betting that the stock will stabilize, while retail traders are buying out-of-the-money calls, hoping for a return to the $20 levels of the past. It creates a feedback loop where the stock price action itself drives more interest. It's the reflexivity concept that George Soros talks about. Higher stock prices can actually help the company by allowing them to raise capital more easily, which in turn fixes the balance sheet, which justifies the higher stock price. We might be in the early stages of that positive feedback loop right now. But let's get real about the risks. The expectations are that the housing market will have a soft landing. The reality could be a stagnation where prices don't crash, but volume dries up. If volume drops, Opendoor dies a slow death. They need churn. They need people moving. If everyone decides to stay put for another year, Opendoor's overhead costs will eat their cash reserves alive. This is why you see such a divergence in analyst opinions. Some have price targets of $2, expecting bankruptcy or a restructuring. Others have price targets of $15, expecting a return to growth. The price of $7.80 is the market splitting the difference between zero and hero. Speaking of holding positions, I want to hear from you. Comment below how many shares of Opendoor you currently hold, and more importantly, what is your average cost basis? Are you one of the diamond hands who held from 2021, or are you a sniper who bought the bottom this year? Let me know in the comments. The psychology of the shareholder base is actually a huge factor in how this stock moves at these resistance levels. Moving on to the Opendoor Exclusives marketplace. This is the pivot that management is banking on. Instead of buying the house themselves, they are trying to become a marketplace that connects buyers and sellers directly, taking a cut without taking the risk. It's a brilliant move on paper because it looks more like Zillow or Airbnb, high margin, low risk. If they can execute this, the stock is drastically undervalued. But changing a business model in mid-flight is incredibly difficult. It requires a different type of marketing, a different sales force, and a different consumer mindset. The market is giving them credit for this transition today, but we haven't seen the definitive proof in the earnings reports yet that this segment is scaling enough to replace the